All right, how's it going, everybody? My name is Antonio, and I'm on the barbecue on December 19 with Sean Cleary, CEO of Strategic Resources, a vanadium, titanium, but mostly pig iron development company with advanced stage assets in Canada and Finland. He's not here with us today, though, as your financial advisor. This conversation is not going to include any recommendations to buy or sell anything. Instead, it will be a casual, general, and an impersonal talk between two people on the internet. And if your mom didn't tell you yet, you're not supposed to blindly trust people on the internet. Do not use this conversation as independent research because it's also going to include a lot of forward-looking statements about uncertain events, and that may or may not happen in the future. And also because the exploration development space is one of the toughest places to profitably deploy capital in because of many risks, which means that it is your responsibility to try to do more research and figure out what those risks are. So head over to setterplus.ca and read the company's official filings, as well as consult a professional investment advisor before taking your own decisions in the end. That all said, strategic resources, and now that's an important difference maybe already, by the way, because there's a few companies out there with the word strategic in their name, and this is Strategic Resources. It's listed on the TSX Ventures Exchange under the ticker symbol SR. And there's an average of about 2,000 shares trading each day with a 52-week high of $3 and a 52-week low of about 85 cents. With a market cap of about 65 million Canadian dollars at the time of recording of this video and about 60 million shares outstanding today, this is a $1.10 stock. There are no warrants and about 3 million options are still outstanding, resulting in about 63.5 million fully diluted shares. Now, over 40% of the company is owned by Orion Resource Partners. That's an investment firm that specializes in metals and mining finance. After the deal they did for one of their projects that I will tell you about later on, that makes sense. And then there's also another over 40% owned by the investment company or the financing arm, if you will, of the government of Quebec. So that's over 80% of the float already tucked away. Ross Beatty, of course, is a large shareholder here. Together with Lumina Group, they own over 4%. Management owns just about 1%, so not a huge amount, but with a few other corporations in there, as well as the Cree First Nations, they're really only are about 5 million shares in the effective public float. Excuse me. As of the end of September this year, the company had about $5.5 million in cash and cash equivalents and about $10.5 million in restricted investments, with a total of about $17 million in current assets. That's sitting against $13.5 million in current liabilities, mostly made up of about $10.5 million in account payables. As I said at the beginning, the company's got two projects. The main focus right now is, of course, on the recently closed RTO deal on the Blackrock project in Canada. Interesting project here because the idea, as far as I understand it, is to mine so iron, titanium, and vanadium, process it on site in the James Bay territory, so close to the Chibougamau district of Quebec, that is. Then truck that concentrate about 25 kilometers to a railway, and then transport it 400 kilometers by train to Saguenay, which is it's a port, and that's also where a pig iron production plant, or as the company calls it, a metallurgical facility, is proposed to be built. That facility is expected to be built right on the port, which essentially means that from rock to final product, which is pig iron in pallet forms, the company will control the whole process. And pig iron, by the way, has little to do with pigs because the way we make it now has changed relative to when that name was given to it. And so maybe a more modern name could be, for the final product that Strategic Resources going for here, could be crude iron. And so Strategic's facility is planned to be able to produce high purity of that pig iron, so 97% iron, that is, in pellets form again, which is used then for steel and alloy making, and that makes it, well, as the name of the company suggests, strategic, because most of the world's production of pig iron comes from China, who of course keeps all of it for themselves. And so the largest exporter of pig iron, accounting for nearly a third of exports in 2021, was actually not China, but it was Russia. And it was then followed by other BRICS nations, Brazil, India, South Africa, which, given that the U.S. is the largest importer of pig iron, accounting for over 40% of imports over the same period of 2021, well, it makes pig iron, as the name suggests, again, strategic to the West. So that's a proposed facility, again, 400 kilometers away from the actual mine, which the mine portion of that proposed project is an open pit proposed mine. Well, Technically, could be two open pits, but only one pit was taken into account during the feasibility study. And that one pit showed a 39-year LOM on it and an after-tax IRR of over 18%. There's an NPV 8 of, let's call it almost $2 billion. And what the second pit has is up for speculation, of course, but the company believes it could be anywhere between 70 to 80% of the size of the one studied in the FS. Getting that first pit operating, though, is, of course, dependent on an upfront expense to the tune of $1.5 billion in expected CAPEX. But the average life of mine revenue for this project is also expected to be relatively high. It's expected at 811 million Canadian dollars, resulting in an after-tax cash flow of $343 million, with the assumption of $50,000 per ton vanadium prices, $395 per ton titanium prices. And that expected revenue, by the way, would have a 65% pig iron, 30% vanadium, and 5% titanium split, as far as I understand it. Again, this is a shovel-ready project, so you can start building it tomorrow, basically, if you have $1.5 billion, that is. But next to that project, the company also has another vanadium project in Finland, which is called the Mustavara, and it could potentially, down the road, be a mill feed for the metallurgical facility in Quebec. This project, though, is a little bit further back the Lassonde curve. It's a project they acquired a while back from Orion Resources, different than Orion, written with an O. This is AU, Orion Resources. Orion Resource, also a shareholder of the company, by the way. And but a PEA was done on Mustavara on the project in Finland in 2021, and it showed a 20-year mine life with an almost 330,000 tons of pig iron and a 4.6 thousand tons of vanadium production per year. There's something's going on with my throat, so you're going to have to deal with it. But this is a past-producing project, and it used to produce vanadium between in the 70s, 1976 and 1985. But it had to stop due to low prices at the time. It had only really reached about 50 meters of depth of the deposit over a 1,000-meter strike, whereas the mineralized zones are anywhere between 10 to 130 meters thick, averaging out at around 60 meters. And the vanadium-rich magnetite zones span an 18-kilometer geophysical anomaly, 10 kilometers of which remains untested to this day, which, as always, is just me trying to sound smart as I'm saying that the company thinks that there's exploration upside to that PEA from 2021. Although, as far as I understand it, they don't have any immediate plans to explore this project. I'll be asking more about that further on in the conversation, which... Well, calling it a conversation is making me remember that I have to shut up at times, like, for example, right about now, and give the word to the CEO. So, Sean, thank you so much for investing your time in me, sir.
Thank you. Thanks for inviting me to the discussion and conversation today.
Pleasure is, of course, mutual. What am I missing or getting wrong in the overview of the company here?
That was an excellent summary, very thorough. I think you hit on a lot of the key points. If we look at the flagship project, which we call the Blackrock project in Canada, this project checks the box in terms of ESG components. One, it's fully permitted during the permitting process, both for the mine and the concentrator, as well as the metallurgical facility. We had no objectors to this project, so social acceptability is very high. The mine itself is located in, just outside of the mining town of Chibougamau. So, we have a population of miners that are very excited to get this project going. Open pit mine, workers can commute from town to the mine location, and our permits allow us to have a concentrator on site. So we'll actually produce a very nice concentrate, 62% iron, 1.4% vanadium, and about 9% titanium. So it's very high in metal content and very low in deleterious elements. And our plan is to produce about 1 million tons of that concentrate per year. And as you said, truck it to a railhead and take it down the CN rail, 400 kilometers to the port of Saguenay, which is a deep sea port, where we've permitted the metallurgical complex. And there we'll produce the pig iron product, a vanadium, intermediate vanadium slag product, and a titanium-rich slag, the titanium is, as you mentioned, about 5% of revenue. And this is going to the pigment industry. So it's really a byproduct of titanium. It's sort of a co-product of vanadium, representing about 1/3 of revenues, and then the balance being pig iron, which is our main product. And as you mentioned, that's going into the steel industry and really into the foundry industry as well as a high purity product.
Hmm. I have to correct myself though, because I caught a mistake. Because I said I think that the ore is going to be shipped, is going to be trucked. That's not true. You're trucking concentrate to the train and then loading it up on a train. So it's concentrate, not ore, just to be specific. But so Sean,
Yeah.
I mean, I believe I get that part, and it seems pretty straightforward. Again, $2 billion MPV, nearly 40 years of mine life, and that's a one pit alone. Potential for a second pit, decent free cash flow. Selling for $65 million market cap. What's wrong?
Well, I think it's a difficult market for developers, for one. We have strong sponsorship. Our plan is to build this out. I think that the market is basically skeptical on the ability to raise $1.5 billion in today's market, frankly speaking. And so, our major shareholders have also asked us to look at how can this project be broken into smaller pieces that would be more easily financeable. And so we've been working on that in the background. And we recently got written permission to use our existing permits at the metallurgic facility to expand the pellet portion of the metallurgical facility to run a much larger pellet operation. So we're currently investigating that and talking with potential partners to bring in some additional strategic partner on that. And we've had a lot of help from Ross Beatty's team. Lumina Group has been just excellent. They came into the company a little over 6 months ago on the RTO, and they've got a deep bench of developers as well as excellent connections in the capital market. So we've been working closely with folks from their team to help build out the project. So, we're still in that area where we haven't completed the project financing, and we're looking at alternatives to really, push that forward and give it some momentum.
That's a good idea there that you're putting forward of breaking it up, maybe like it's something like a starter pit, or like what would that look like?
It would be more of a merchant operation to produce DR grade pellets. So at the metallurgical facility, which is located at a deep sea port, Port Saguenay in Quebec, this is a federally owned port. The port has been the port has been doing transshipments of pellet feed that's coming out of the Labrador Trough. So, Rio Tinto's operations and other operations up at the Labrador Trough. And they've been shipping pellets down into the Saguenay port, where they're transloaded onto Lakers, and they go down into the Great Lakes, the steel plants that are in the Great Lakes in North America. So, the port came up with an idea to enhance their industrial park, where, we have a lease on a large portion of the industrial park there, and we're the first tenant. And so the port has now got federal and provincial funding in place to build a conveyor to take pellet feed from the wharf up to the industrial park. And so as part of that, we thought, well, one way to break the CAPEX into a smaller chunk would be to start with a pellet operation. So this is already permitted as part of our process flow. And so we went back to the folks at, the Ministry of the Environment, and talked about how we could utilize our existing permits and scale up the pellet plant and produce pellets on a merchant basis for other industry participants. So that's something that we're in the middle of investigating right now. Last week, we did put out a press release around the funding for the conveyor, and this conveyor is now in construction at the Port of Saguenay. So it's an exciting opportunity for the company because there's huge demand for pellets that will go into direct reduction furnaces that feed electric furnaces for green steel production. And this is really part of greening the entire steel industry, certainly within the Western world, where essentially we're getting a lot of government incentive and government involvement to convert existing steel furnaces, which are blast furnaces, to electric furnaces. So you see that happening across North America and Europe. And that's, a significant change for the material flow for steel industry. Blast furnaces typically take about 25% of their ingredients are scrap steel, but an electric furnace operation is more typical, like 75% of the charge would be scrap steel, and then the balance is what they call ore-based metallics or virgin iron units, which are used to get that steel product to spec. So that's typically made up of either DRI, which is direct reduced iron, HBI, which is hot briquetted iron, or pig iron. So the demand for DRI, HBI, and pig iron is going up significantly. To give you an example, in just one of the plants in Ontario in 2027, when they complete the conversion, that plant will increase its utilization of pig iron by an incremental 1.2 million tons per year. And you're seeing this happen across really the Western world in all of these steel plants as they convert. So there's a lot more interest in the development of new feedstocks for electric furnaces. DRI is made with iron ore pellets, and you need a certain grade of iron ore pellet to have a good DRI product. So as you mentioned, this is sort of like a crude steel product in the sense that you're taking iron ore pellets, and which are iron oxide, and you're metallizing those through a furnace process into what they call DRI. So we'd like to be part of that. We already have a very interesting permitted pig iron product that we would make at our metallurgical plant. If we could process pellets to feed into other DRI plants, or even feed into an expanded operation within Saguenay down the road, this is something that we think is really exciting for the industry. And look, we've got the government behind us. We have the Cree and the Innu behind us. We've got groups like Orion and Lumina Group behind us. So these are real believers in this project. And I think, the story is new to the market. And it's an interesting part of the steel industry that not everybody understands. And there's a lot of transformation going on within the steel industry as it reduces carbon emissions. And essentially, electric furnace steel produces, 1/3 or less of the CO2 emissions that a blast furnace operation produces. And that's why you have governments really, really motivated to incent the industry to change. So that's basically what we're trying to take advantage of.
How much will that knock off your timeline? And also in terms of CAPEX, you said it's in pieces. What kind of pieces are we talking about? Is this sort of a 20% upfront of that 1.5 billion, or like how do you look at it?
Yeah, we were looking at various options to, maybe have a CAPEX of about 1/3 of our initial. We had initially set out 1.5 billion. So if we could, start with something that's smaller, that's very interesting to our large shareholders. Much more easy to fund, much more easy to bank, much more easy to bring in another partner. So, that's kind of what we're focused on. We still, it's early days on this. We're still doing a lot of, work in terms of, scoping out what the engineering is, and the equipment providers, et cetera, making sure we've got a lock on what the economics of this type of operation would be. But we should have news out during Q1 to basically tell the market where we're headed. And I think as we get there, we've seen positive information out in the market recently because of the announcement that the federal government, this is really the first time that the federal government of Canada has been specifically involved in the Blackrock project by helping to fund the conveyor. So news like that is very helpful as well.
Right. And you think there's nothing that you can tell me about timeline right now then?
Yeah, we'll basically report our findings of our investigation probably sometime before the end of Q1.
Right.
And at the same time, in parallel, we're talking to potential partners, and if we're successful in putting together a partnership, I would see that timeline being kind of similar, maybe Q2. And then if we may also just go it alone because we have the backing of a number of big sponsors on the project. So I think, certainly by the summer, we'll have a lot of news out around, what we're doing in terms of this potential for the pellet operation.
Right. But I meant more like a timeline of when do you think you can start cash flowing in some form?
Yeah. Well, if we go forward on the pellet operation, it does reduce the overall timeline. For the whole project, it's about a 3-year build so basically from when we would complete the project financing. It would take us about 3 years to complete construction and get through the initial parts of ramp up.
Right.
If we go with this, the sort of pivot on the pellet operation, then I would say that we'll be in a position where we could probably cut a year out of that schedule and be cash flowing that much faster.
Okay. And so why I'm asking that is because I would also believe that the lack in share price movement, or actually the share price going down, could also be attributed to there not really being any material news since you did that deal of the RTO, right? So, well, this actually might be a twofold question, but let's start with that. So you think that you're going to be able to come out with more news releases next year, starting in Q1, or do you think that it's still going to take some time for you to ramp up that news cycle, basically?
Yeah, I think we'll have more news out in the first half of next year than we've had in the second half of this year for sure. The news flow has been slow, and I guess my view on that is like we're trying to build a company, not a promote. So we want to put out meaningful press releases that helps the market understand how we're building the company, what the strategy is, and what our timelines are going to be. So we've been somewhat conservative in that regard, making sure that we have the information right before we put it out. So we have put out a press release in late August, September regarding our collaboration on hydrogen with Cipher Neutron. We've put out the press release now about our funding for the conveyor at Port Saguenay, which is $111 million funding from the federal government and the province of Quebec to the port for the conveyor system, which is essentially for this project. And we will be hopefully putting out a couple of news releases in January and February, all related to the work that we're doing both on the hydrogen side, because, look, there's a huge focus on getting to zero in terms of CO2 emissions for metallurgical plants. And, so that's part of our focus as well. How do we enhance the overall operation? to see if we can take it from essentially what Tenova is our supplier on our DRI furnace, and as well as on our electric furnace for our pig iron. And they publicly said that this is once built the greenest pig iron plant in the world. It still does have some CO2 emissions, so we've been very active in terms of pursuing potential technologies to take that CO2 to zero. So, and we've identified 2 so far, and maybe 3 that we will, that we're investigating deploying as part of our process flow, so that we have as close to zero CO2 emissions on this project. And we believe that that's what the market wants. That's what the automotive steel customers need. That's those automotive companies, those OEMs are looking to their steel suppliers in terms of measuring what their carbon footprint is, and those steel suppliers are looking to their raw material suppliers to say, like, okay, what's the life cycle of CO2 emissions that is actually going into these steel products that we produce for market. So this is the future. This is where all of the Western world is going, and we want to be part of that, because let's face it, the steel production and iron production are huge emitters. Something like 10% of global CO2 is produced out of steel and iron.
But bottom line, because you mentioned strategy there, you're absolutely determined that you're financing, staffing, building this project on your own, potentially with a strategic, but this is not, you're not at a stage where you're looking for someone to buy you out completely.
Well, not at this stage. Our focus has been to build a business, and our focus of our shareholders and the backing of the shareholders that we've had, which has been significant, has been to build a business. Now, we're in business to make money, and we do have shareholders that are financial. We have shareholders that are strategic, and we have shareholders that are, government. So if there was a bid for the company, everybody would have to act accordingly. But we're not building the company necessarily to sell the company. We're building the company to build a business. If somebody came along and wanted to buy the company or partner with the company in a way that changes the corporate configuration, we're always open to those discussions.
Right. Okay. Well, that's an interesting thought to be had. But again, I don't assume the involvement of Ross Beatty and Lumina Group as a whole is to be taken lightly in this case. Shout out to them, by the way, for making this interview happen. They connected us, so I'm thankful.
Yes.
Thankful for that. The project itself, Blackrock, as far as I understand it, was in bankruptcy prior to the new shareholders getting involved. You were the CEO of Blackrock Metals, if I'm not mistaken, prior to this transaction. You've told me a little bit about that, but what's changed this time around? Like, why is this not going to happen this time, is what I'm asking.
Yeah, well, the financial restructuring of the company Blackrock Metals was initiated by our largest shareholders, who were also lenders to that company. And Blackrock Metals had got into a dispute around an offtake agreement, and that's really what triggered the restructuring of the company. So the 2 major shareholders, who were the shareholders of Blackrock Metals, continue to be the 2 major shareholders of Strategic Resources going forward. So it wasn't for necessarily a lack of resources. It was more for giving the company a clean balance sheet and being able for it to move forward and get the financing that it needs in terms of building out the larger project. So that was the impetus for the restructuring, and then followed by we recast all of the costing in November 2022. We did a full 43-101 final feasibility study on the entire project, and then used that as the way to do the RTO with Ross Beatty's group, which we completed in March 31st. of 2023. So, we've been public now since March 31st. And, I would say that between, the end of November 2022, when we finished the feasibility study, and when we came out in the RTO for the public in March of 2023, the market also shifted a little bit, and it was much more difficult for developers of large projects to attract, 1.5 billion, $2 billion projects. It was just that much more difficult to be able to go after them. So that's when we sat down with our stakeholders. We sat down with our major shareholders and said, okay, so we're going to think about this a little bit differently. And that's where we started to look at, we knew that we had to do work around hydrogen. So that's something that we focused on. And then we also, basically thought, how do we think about this project differently so that it's more easily financeable in the current market? So really that's what our focus has been.
Right. Okay. And the $1.5 billion CAPEX, are you going to have to do any other feasibility studies if you have to split that in three, or do you think you can just go ahead and start building basically?
Well, there's some engineering that will have to be done on the total project in terms of, we've done full feasibility studies on the entire project.
Yeah.
And in terms of the detailed engineering, which is, the work that gets done just, as you go into construction, we're about, 60% completed on detailed engineering for the mine and concentrator. And we're about 35% complete on detailed engineering for the metallurgical complex. So because we're shifting potentially to scale up the pellet operation at the metallurgical complex, we're going to have to do a little bit of rework on some of the detailed engineering, but we also need to complete some of the detailed engineering on the larger pellet plant as well. So we'll have a phase where we're working on detailed engineering and procuring the long lead items for the pellet operation. If that's what we get a notice to proceed on that part of the project, from our board and financiers.
You don't often see companies doing that, though, right? I mean, just mining companies owning the metallurgical facilities and the mine at the same time and doing just the whole circle. How come?
Yeah, that's a good question. So, look, when this company was just Blackrock Metals, and prior to its merger with Strategic Resources, we really focused on initially, looking at this deposit that we have near Shibugamu, which is a very large and interesting deposit that's very high in iron. So, but it also has vanadium and titanium in it. So we were looking at that as purely a mining play where we would, produce what we call a VTM concentrate, which is the iron, vanadium, titanium concentrate that I explained earlier. And, ship that down to the port, put that on large vessels, and, ship that overseas to markets. And really what we found was that that's a difficult proposition because the world of, steel producers and the world of vanadium producers does not exist. It's difficult to find companies that do both. So finding a customer just for our concentrate product proved difficult, and that ultimately actually led to the restructuring of the business because we entered into offtake contracts with certain parties where we were to get credit for the vanadium fraction and the titanium fraction of the concentrate, which ultimately turned out we weren't going to get that. So we were really only going to get paid for the iron portion of the concentrate. And that at that scale, at that size, from that location, was really not a viable product. So we kind of, after a few years, went back to the drawing board and said, okay, what's a better way to run this project? We should forward integrate to have our own metallurgical complex. If we can take this from oxides to metals, then what we can do is we can capitalize on the margin, and the margin is significant for the vanadium and titanium portions of the project. And that really is what makes the company's economics work. So essentially, you can think of, in terms of the overall project, the pig iron is essentially paying for everything, but, the cherry on top is the vanadium and the titanium. So as a kind of polymetallic, fully integrated operation, that's, a better strategy. And, the counterparty risk on offtake, because all of those products, well, 95% of revenues will be coming from all Western world companies. That's a better financeable plan for the business. So those were really the main drivers. And then, we had the Quebec government as a significant sponsor early days in the project. And, part of that was, I think, the government was looking at Port Saguenay, which is a federally owned public port, but it forms part of the industrial base of Quebec. So they were looking at that to say, well, how could we expand industrial operations at Port Saguenay? And really, the Blackrock project really fit the bill in terms of being, a major driver to expand the operations of the port. So it's a port that's open year round. It's, just around the corner from the Rio Tinto Alcan ports. It's a great location, hooked up to natural gas. You have hydroelectric power, low cost in Quebec. We have those utility contracts already in hand with our providers there for our project. So, these are very valuable assets for the company. And, overall, to have a metallurgical plant permitted within the North American context is something that takes a lot of investment, a lot of time. It's tremendous scrutiny in terms of the environmental process to get to that point. And we have all of those permits now. So again, we kind of looked at that as like, wow, we can build a really significant integrated business that when times are tough in the market, we're going to be a low cost producer, sort of tier one on all three of our products. So it's something that would, be really potentially a company making generational asset. And that's how we look at this.
Hmm. Who's the end buyer of the product? So it's 65% pig iron, 30% vanadium, 5% titanium. Um, is that one party that's buying everything, or how are you going to be selling that?
Yeah, on the pig iron, which is the vast majority of the revenues, we kind of look at it like there's two major markets for our product. One is North America and one is Europe. And those are the markets that we want to feed. So how we look at that is, potentially having, one or more local buyers for the North American market for maybe 50% of our production, and then the balance into Europe, probably with a trading group handling the European market for us. On the vanadium side, there's a couple of large players in the vanadium business, and our view is to have an offtake with one of those players. So that would be, in essence, one buyer, but ultimately the end market for vanadium is into the steel industry. About 80% of vanadium goes into the steel industry as a ferroalloy for increasing tensile strengths of steel. And the balance largely goes into the battery industry for grid level flow batteries, for solar and wind, et cetera. So we would participate in the offtake on the end market. But we wouldn't have any counterparty risk. So that's how we had sort of set up the thinking around that. That offtake's not signed, but largely, we know where we think the product will go and who it will go with at this point. On the titanium side, that's our product would go into the pigment industry for producing titanium white. And that could be into Europe or Asia, big pigment companies in both locations. So, but it represents 5% of revenue, so it's quite small.
Right. Well, but metallurgy costs, well, basically splitting, it's because it's uranium vanadium. It's iron vanadium, not uranium vanadium. It's iron vanadium. Splitting those two, it's basically an expense in terms of OPEX for the company. And so when I'm looking at polymetallic deposits, I also try to pay attention to the fluctuations in the prices of the different metals, because obviously if iron ore price is very high, but then vanadium is let's say lower than what it costs you to liberate the iron ore from the vanadium, it could, in some occasions, maybe no longer be a credit. It could potentially become a drag, basically, as I understand it. Like, could that happen for you, having that structure for the offtake agreements? And do you have ways of managing that?
So the process flow for the iron concentrate that's coming out of the open pit mining concentrator at Chibougamau is to take it by train, bring it down to Saguenay, have it pelletized, directly reduced, and then it goes into an electric furnace. And in the furnace, we remove the titanium as a slag. So the titanium product is a titanium-rich slag. It's really a byproduct of the process.
Okay.
What you're left with is hot metal that contains iron and vanadium, and that goes into a converter, which you blow oxygen into the converter, and it produces a second slag of vanadium. And so that's taken off, and you're left with the iron product, which is cast into pig, what they call pigs. So that's the product that's going to market. So really, what you're taking off in terms of the titanium slag, the vanadium-rich slag, are really waste products that you're able to sell into the industrial market. So I guess I don't quite view it the way you said it. It's more like this is the process to get to pig iron, and the materials that would, potentially, if you didn't have the process that we've set up to produce these things, those would be, slags that would go to waste. But really, they're slags that are valuable slags that we're able to sell. So it's a different way of looking at a metallurgical complex. And, really how we came to that was focusing on having the lowest solid waste out of a facility that we could have in order to, really focus on the sustainability elements of the overall project. And we were very successful in being able to do that, partly because we had a very good, clean concentrate to start with that was high in metals. So, so that was our focus. And now, having that behind us and, knowing what that process is, now our focus is on the emission side and making sure the emissions are as close to zero as possible.
Is that a turnkey solution process that you just described for me, or could there be any novelty challenges related to it?
Yeah, that's a great question. So on VTM concentrates, it's, so there hasn't really been direct reduction through an HYL furnace with, VTM pellets. However, we did a lot of testing. As I mentioned, Tenova is our OEM on the direct reduction. So they're part of the Tekint group. So we did commercial level testing on our material at their Monterey facility to make sure that the metallization and the liberation of the metals would, do what we thought it was going to do. And in fact, all of those tests came back extremely better than what even Tenova expected in terms of the metallization and how the process works. So there's nothing novel about really what we're doing in terms of the machinery. Pelletizing, induction furnace pelletizing has been around for 100 years. DRI, the HYL system that we're going to use has been around for 50 years. The OSBF furnaces, which are the form of electric furnaces that we'll use in the process flow, have been around for about 50 years and were used extensively on liberating vanadium ores in South Africa, and were actually developed by Pyromet, which is part of the Tenova organization. So, these are, well-used technologies to produce these metals. It's just, I would say that our process flow is incorporating elements to make sure that we have as, little to no solid waste, and that we're recapturing all of the process gases and reusing them in the direct reduction furnace. For example, the hydrogen and methane and other gases. And as I mentioned, now we're really focused on, okay, can we have as well something of a novel solution around the hydrogen and the CO2 capturing to take the plant down to zero emissions. So, and in terms of the metallurgical testing that we've done, we've taken our product all the way through to metals and, basically passed at every step.
Okay. It's, would that matter for you? Would there be any grade fluctuation or something like that in that process though?
Well, there could be the iron concentrate coming out of the concentrator at Chibougamau is expected to be 62% Fe or higher. So if, and that's quite high actually for a VTM deposit. Typical VTM deposits run around 58% iron in concentrate. But as I mentioned, our ore is very clean, and so we have a very nice concentrate product. So, the grade issue for yield could be affected if you had a lot lower iron content. So that's, I wouldn't call that a risk because we've done so much drilling and so much work work on designing the liberation of the concentrator at Chibougamau. But if you had lower grade iron, then you would get lower yield.
Okay. And then that concentrate gets trucked to the train, and then the train takes it to. Would it be possible? And I know you didn't do that in the studies, but and maybe you can tell me about why not. But would it be possible to have a conveyor belt? Because what is it, 25 kilometers from the mine to the train?
Yeah. So what our permits require is they've given us permission for the first 5 years of production to truck the 25 kilometers. However, in the 6th year of production, we have to have a rail spur installed. So, and we've done a lot of the work on the rail spur project. And we have an MOU in place with the Cree Nation because, our Indigenous partner, we have an IBA, so we have an impact benefit agreement for the life of the project with the Cree Nation government and the local band of Ojibougamau. Our partnership agreement with them also, besides that, we have implementation committees in place, and we work very closely with the local community. As part of that, we wanted to, in our permitting process, address the issue of trucking, and both for efficiency's sake, but also for environmental purposes, to really reduce the footprint there. So in the 6th year of production, we will run everything by rail spur. And the rail spur, the thinking behind the rail spur is that that will be a partnership project with the Cree. So we basically have put an MOU in place with the Cree for that, and we'll be working as we get closer to the construction date for the mine and concentrator. We'll be working to try and put that in place. If we can put it in place earlier or even at the initial start date, that's something that that we would push on. It's really a question of construction complexity and CAPEX, and how much partnership dollars the Cree want to put in on that.
Right, right. Again, CapEx as well. I mean, it's good that you can do it after 6 years because that means that you're going to
Yeah.
be having that $300+ million of cash flow helping you build that. What's the topography there, by the way? I mean, do trucks go up or downhill when they're carrying the ore on their way to the train?
Uh, Generally coming downhill. So the where the deposit site is the high ground. It's actually the watershed for the entire James Bay region. So the deposit itself is on a ridge. And so where the concentrator will be located is essentially near the top of the ridge. And so the trucks would be loaded there and coming down to where the CN rail is about 25 kilometers, the existing rail from where the concentrator will be located.
Right. Okay. That makes sense. The whole thing sounds like a labor-intensive project, though. You said that you're gonna have access to labor in the Chibougamau district, but do you have enough access to enough labor in both the mining and the iron producing areas?
Yeah, well, we hope so. We think that, so for the mining operation, we basically have a little bit of a leg up on competing for labor in the sense that, well, one, we're in a mining town, but two, a lot of folks who live in Chibougamau are on fly-in, fly-out type schedules for different mines in the James Bay region. So for ours, it's a commute. So we would bus the workers. It's about 45-minute to 60-minute drive
Mm.
from essentially downtown Chibougamau to where the concentrator and deposit are located. So that's a significant advantage from a recruiting perspective. You know, Chibougamau is a mining town of about 8,000 population. So, and it's kind of the jumping off point for northern exploration in the province as well. So, you have a lot of mining service companies, essentially, everybody that's large stakeholders in the mining industry tend to have, a branch office in Chibougamau. Down in Saguenay, Saguenay is a large municipality. It's about 150,000 people. It's the home of Rio Tinto's Alcan operations. It's a very, industrialized area. So universities, large training centers. You have foundry businesses in Saguenay as well. Saguenay, 150,000 people recruiting there. It's expected, these metallurgical plant jobs, like the steel industry and the aluminum industry, they tend to be very high paying jobs. So we're expecting to be able to attract people, and we have a large population there. So that's used to working in heavy industry.
Is there some sort of an internal decision on keeping the First Nations involvement within the company to a certain percentage, like having 10 or 20 or whatever, how many ever percent it might be of the workers being First Nations?
Well, we have agreements with the Cree for the overall project. We also have three different well, no, we have two different development agreements. We have three agreements in place in total, one IBA with the Cree, and then two development agreements with the Innu. none of them have job quotas for Indigenous personnel. But, we are interested to work with First Nations peoples and, invest in training, sponsor people. We want to, build knowledge within these communities, both on the mining and concentrator side, but also on the more industrial metallurgical pieces as well. So we don't have exact like quotas, I would say, but we would be very interested in working with First Nations people.
Right. Okay. Why I'm asking this is because prior to the restructuring of the company, you had different timelines, right? And so different promises were made towards the communities, and I'm wondering about whether that can still have an effect on what's happening today. Um, so that's where I'm coming from with these questions. But I think I'm getting a better idea of where this is headed, where you plan on taking it. 2024 is basically going to be set aside for construction decision, financing decision, efforts to find that money as well. Even if you split it in three parts, though, in one third, one third, one third, $500 million at a $65 million market cap valuation is not easy. Talk to me more about that financing. What could it look like? What do you want it to look like? Debt, equity, partners, and so on and so forth.
Sure. Yeah, and just to finish on the First Nations groups, look, I think why we've been successful in terms of dealing with local communities, we also have cooperation agreements with all the municipalities that we touch in the project, is because we've been very transparent from day one about what we're doing and how we're doing it and what our schedules are and what the risks are, et cetera. So, and I think these groups are very professional and they understand that projects don't always necessarily go perfectly smoothly and you have stop start. So everybody's on the same page there, and really our stakeholders are very happy with how I think we've dealt with them, and we're very happy with how we've been treated reciprocally. So, and I would say that we're really marching forward with them shoulder to shoulder. And and hopefully that continues. On the financing side, look, if we do the smaller stepwise approach to the project and we bring in a partner, then that would reduce our equity stake that we would have to put up, maybe by as much as half, which is very significant.
Mm.
We would expect that the partner could buy into the smaller project or the overall project. So we're potentially looking at those different scenarios. And then if we think about what the debt is, we've always sort of thought around 50% debt to equity is very doable. Depending on who the partner is, then we could have significant upside in terms of what the debt level could be for the initial project. So, but we kind of think about capital structure: 50% debt, 50% equity. We have strong sponsorship from our existing shareholder base, who have committed to move forward with us. So, and that's with significant dollars, and these are groups that have very deep balance sheets. So, our expectation is that they would participate, and I think we have some great names around this company that would participate in our overall project financing. So, despite the fact that, we have a small market cap today, I think we're going to see, tremendous interest in the company if we're able to get these plans, moving forward in the next number of months.
And I think that's exactly important to be able to communicate that to the market, that it goes beyond what you see in that FS. It goes beyond that $1.5 billion, $65 million company. They're never going to be able to do that. Well, there's ways to do it. There's
Right.
backers, there's whatever. And so the conversations like these are important, and I appreciate you clarifying that for me. Um, I'm not hearing much about government involvement, and you recently, as you said, published a news release saying, congratulating basically for that grant on the port. What about grant government money? Basically, is that a possibility? Is it a probability? How big of a probability is it? Talk to me about that.
Well, I think really there's two buckets that we look at. There's the provincial government of Quebec, who are major shareholders of the company, holding just over 40% of the company today.
Hmm.
And our belief is that they would participate in the overall CAPEX of the project to a very significant extent. We have had confidential discussions with them about that. They've been very positive. Even I think if we moved to the stepwise project where we were doing pellets first, they would also have involvement there. So, you know, um, in terms of the federal government of Canada, we're seeing the first involvement of the feds in terms of helping to fund the conveyor system. That's very important. The federal government has already committed, significant capital to the steel industry in Canada to do their blast furnace conversions. This is in the billions of dollars. And that money is being spent over the next 3-4 years to complete those conversions. This is at in Hamilton and Sault Ste. Marie and other places in Canada where we have major steel production. So we believe that the next step is for those plants to secure raw material feed, and for the industry to have pig iron production in Canada. So we do believe that overall, this is very interesting to the different federal government agencies that fund these types of projects. And, we're in discussions with some of these groups today. Overall, as well at the port, there is, a significant amount of related infrastructure that is going in to be installed around the port. So there's an extension of the existing gas line to bring it to the industrial park. There's high powered electrical transmission lines that have to be brought over to, it's about 14 kilometers, that have to be brought over to feed the electric furnaces, et cetera. And there's processed water pipeline as well from the municipality of Saguenay that has to be installed. So these are significant related infrastructures that these are all being funded outside of our balance sheet by province of Quebec and some from the municipality of Saguenay, involvement now from the feds on the conveyor. So, we think we have very, very significant sponsorship through the government levels, and potentially right into the CAPEX.
Right, right. Okay. But there's not, I mean, what I'm talking about is the lithium, or what I'm thinking about, better said, is some of the lithium producers, especially in the US, who just got money from the government because there was these specific programs that were put in place that they could apply for. But with you, is more of a tailored solution, basically, as far as
It
I
is.
understand it.
It
Yeah.
is a tailored solution. And, I would say that, traditionally the Quebec government has funded projects like this to the tune of around 25% or so of the CAPEX. And, we would expect that it'll be something in that neighborhood.
Mm. Good, good.
Yeah.
Okay. I think I'm getting a very decent picture of what's happening in Blackrock. Um, I do want to hear a little bit more about the operations in Finland. Is there anything else, though, that I'm missing on Blackrock that you think is important to talk about here?
Um, No, just I think, to reemphasize that it's a very green project and, the shift that's going on within the steel industry today. So when you go to steel conferences today, it's all they talk about is, the shift to CO2, how can we invoke hydrogen as a solution, et cetera. And, we're really at the cutting edge of all of these discussions and, potentially getting the interest of the industry in this regard. So I think that's very, very important to emphasize. In terms of Finland, the Finnish asset, which is, as you mentioned, a former producer, Mustaverin mine, produced a very similar concentrate to what the Canadian operation can produce. So, around 62% Fe, 1.4 plus percent of vanadium. And at one point, that mine did produce about 10% of the world's vanadium. So, it's a significant asset. For us, the way we look at it is, the issue is getting the company into production. The fastest, easiest way to get into production is to focus on the Quebec location. But to maintain the optionality for the Mustaverin project in Finland is very important. And at one point, that could feed the metallurgical complex in Quebec as well. I think, jurisdictionally, it's got a couple of additional issues compared to Quebec, especially on the cost of power and, just getting the operation up and running. So that's really why we're focused on Quebec first. But Mustaverin is a great asset to have in the company's portfolio.
Okay, that last part might be an interesting point, because I was going to ask if you would consider a sale of the asset as part of financing Blackrock. Like if someone came along and said, "Here's that amount of money," would you consider it?
Yeah, I mean, I guess the way I look at mining companies is, you have a number of projects, and it's a portfolio approach. And if there was the right deal in place, yeah, we would partner with somebody to develop it. We would, potentially do an outright sale if it helped finance the other part of the company. So, all of those things are things that we're willing to discuss with groups.
But you're not actively looking for someone to sell the asset to.
Not today.
Okay, understandable. Yeah. What about in the meantime though? You've got again some cash in the bank. Would it make sense for you to go looking for another project close to the Canadian operations, cough, Vanadium Corp, something?
Right. Well, we've looked at all kinds. So, Scott Hicks, who is our on our board and our head of corporate development at Strategic Resources, and who's part of the Lumina Group, and I think that's introduced me to you, Antonio. He's really running hard on that part of our company, and we're looking at everything. And so that's our job, which is to, build the value of the firm, the value of the company. And so I can tell you that we're not leaving any stones unturned. Overall, our focus is to, go with the strategy that's been laid out and approved by our board and shareholders. But if we have an interesting opportunity that crops up, then we're going to pursue that.
Right. But in terms of, okay, let's not go there. I get it. That was a good answer. How's G&A right now? I mentioned that you have some cash right now. How far does the cash that you have right now in the bank take you in terms of G&A?
Well, we're working on the project financing. So, we've had discussions with, the international banks. We've engaged on different mandates with some of our investment bank to look at, how do we fund the project, either on the, stepwise pellet idea or the overall project. So that's really what we're focused on. When we completed the RTO in March, we had set out that, we would have about, 24 months or so of working capital. That's what we put in place. That really hasn't changed. That's where we're at today. So, yeah, we're just working our program. We may increase our spending a little bit in Q1, Q2 here as we work on those engineering studies to complete the investigation on the pellet side. But that won't have a material change to our overall runway.
Right. Okay. What are you doing in terms of marketing, by the way? Because again, this is sort of a tricky portion of the Lausanne curve to market in, right? So because it's called the boring part of the Lausanne curve, if you will.
Right.
So yeah, I mean, what are you doing in terms of marketing, and are you ramping that up in 2024?
Well, I look, we only just went public in March and we've been out telling our story. We've attended numerous conferences, meeting with shareholders. We have different digital strategies that we've put in place in terms of marketing the company, doing interviews like this, just getting exposure, industry exposure as well. So, we're part of IIMA, which is the International Iron Metallics Association. We're part of Vanatech, which is the Vanadium Association. So just making sure like everybody in the industry and related to the industry and the marketing of the industry is aware of what we're doing. So
Hmm.
that's been our focus.
Right. Okay. What's the budget for 2024? Do you know that off the top of your head?
Budget for marketing.
Marketing. Yeah.
Um, Not exactly. I would say that we'll continue to do everything that I just said. I don't think we don't have it as one budget line item. It's broken out into many different into many different areas. But let me ask you this: what would you expect to see from a company like this in terms of spending for marketing?
It's a good question. I'd probably have to ask you what the G&A is, because I would then just think about what portion of it um would be marketing. So yeah, what's the total burn?
About 5 million a year.
5 million a year. Okay, a year. Well, that's actually decent. Yeah. So I would expect that you can do anything between this stage. It's a good question, actually. I haven't thought about that. 500 to a million. It's a very wide range, so I feel like I'd be safe there.
Yeah. Well, that would be a very significant spend in terms of marketing. We're probably a little bit less than that,
Hmm.
but it depends how you add it up, because, at the end of the day, what is marketing? Like we get a lot of hits through, social media,
Hmm.
website, other things. So like if you count up all of that, yeah, maybe we're at that number.
Right. Right.
Yeah.
Okay. Good. Well, I don't think, I mean, there's always a lot more to talk about, I suppose, but I also don't want to keep you all day. What is this? Something that you came here hoping to talk about, but I'm failing to bring up in the meanwhile?
No, I think, we've hit on a lot of aspects of the project, the good points of it, where the risks are, the strong backing that we have, the ESG components of the project, which are, really spectacular. Our work with the environment agencies and the indigenous groups, First Nations, we continue to focus on that. Our investigation into carbon capture technologies and hydrogen, and our work to try and stepwise the capital spend in terms of the overall project, and to really focus on what's going on in the steel industry, because for us that's where we see the big opportunity. We see huge changes coming in material flows for the steel industry as it tries to reduce its carbon emissions in the Western world, which is where we want to be. And yeah, so I think we've hit on everything.
Right. Yeah, I agree. Well, Sean, thank you so much for investing so much time with me today. It was a pleasure speaking to you, and I'm looking forward to further conversations.
Thanks, Antonio.